All right, so today we're going to cover our DSCR program. I would say this is probably the second most popular non-QM program that we offer, second behind the bank statement loans. This is a really great resource for your investors or seasoned landlords. It's a very reduced documentation. The big sell behind this program really is the ease of qualifying and the ease of going through the loan process. We only are looking at the subject property here. So that's a great selling point to real estate agents and your borrowers as well. If they own a lot of properties, this really is the most streamlined program that we offer for investment properties. So real quick, I'll just show you a copy of the DSCR matrix. You'll see we do have slightly higher FICO requirements, slightly lower LTV maximums on this just because it is a reduced documentation program. We're really looking at very little here other than the borrower's credit and their ability to make payments on mortgages and other loans. So because of that, there are some slightly tighter restrictions in terms of qualifying. You'll see that the mortgage history does need to be on time for the last 12 months. We do have 36-month seasoning on foreclosures, short sales, deed in lieu, and also your bankruptcy seasonings are at 36 months as well. We have two options for the DSCR. You can be at or above 1, and that obviously gives you the most flexibility when it comes to LTV and FICO and options that you have available. If your property cash flows, anything is pretty much open to you. If for some reason the DSCR comes in and your cash flow is less than 1, we do still have some options. They just get a little more restrictive in terms of the FICO requirements and the LTVs that we can offer. And you'll see we've got $100,000 as our minimum loan amount. If your DSCR is under 1, we do cap that at $250,000. Then our max loan amount is $2 million with max cash out of $500,000. One of the great selling features that we offer on the DSCR program as well is we have an interest only option. There's a 30-year fixed IO, and this is really great for the borrowers, especially now as mortgage rates are going up, loans, and obviously the payments are going up along with it. The interest only option allows them to qualify on just the interest only payment. So you're comparing the interest only payment to the rent as opposed to the fully amortized 30-year principal and interest. So it gives you some options as well with these slightly higher rates to get that DSCR above 1 to open up some options where it might not be otherwise available. All right, going through just some features of the program. DSCR, what does that stand for? It stands for debt service coverage ratio. This means basically the loan is solely qualifying on the cash flow of the subject property. And because of that, occupancy is the most important factor that we consider on these loans. It has to be a true investment property for the borrower. This can't be something that they intend to occupy in any capacity. This should be something they're held for business purposes and rental purposes only. As I said, it is a business purpose loan, so they cannot occupy it, nor can a family member. Or if they are intending to own this property in an LLC, none of the LLC members can occupy it in any capacity as well. We can offer vesting in an LLC, corporation, or partnerships. The borrower or combined borrowers, we have a 2-borrower max, do need to be 100% owner of the company that you plan to vest in. We do have a 2-borrower max, but we could consider up to 4 on an exception basis. It depends on the qualifications of the loan itself and how the business is set up. First-time investors are allowed. So while this is geared towards your seasoned investors and seasoned landlords, we do allow first-time investors. We have a slightly reduced max LTV at 75% for them. And we do not allow first-time home buyers. That's the only caveat. So the borrower does at least have to have owned a property in the most recent 3 years to qualify for the DSCR program. It does not have to be obviously an investment property. It does not even have to be a primary residence. They can rent a primary residence and still qualify if they own other rental properties already. We do still need to document a 12-month primary housing history for these borrowers. As I said, that can either be in the form of owning a primary residence or they may rent it as long as they're not a first-time home buyer. We do apply a prepayment penalty on all DSCR transactions unless it's restricted by your state. And in that case, it would need to be priced or bought out accordingly. It's a standard 3-year term, and it can be bought down or out in 1-year increments. So you could do a 3, 2, 1, or you can buy it out entirely. Non-warrantable condos are also allowed. We don't do true condo tells, but if you've got any non-warrantable condos out there, they would qualify for the DSCR program as well. And going back, as I said, the most important thing with these loans is the occupancy. It really needs to make sense as an investment property for the borrower compared to their primary residence, as well as fit within their portfolio. One of the first things we do when we look at these loans is to open up and see where the borrower is living and what the subject property looks like and compare that it really makes sense. This comes in a lot with the borrower who owns their primary residence. If they are renting and they already own investment properties, we can usually be a little more flexible. But if they own a primary, for example, and their primary is valued around $300,000 or $400,000, it's a standard 4-bed, 3-bath, and then they're looking to purchase a 6-bed, 5-bath, $800,000 property that's not in an obvious rental market area, that might be something that we look at a little closely, because we don't want a borrower who's trying to qualify for a property they truly intend to occupy, but they don't intend to rent it out. We do have a few types of properties that are ineligible. This is not going to be for any agricultural or rural properties. Anything over 2 acres would need to be considered for an exception. Those just don't typically fit within the mold of what we're looking for a true cash flow rental property. They can be considered, anything over 2 acres could be considered on a case-by-case basis, but we're really going to stick pretty closely to that 2 acres. You're really not looking at anything more than maybe 3, and it would need to be in a very suburban area, that makes sense, that would have a lot of rental activity. Farms and hobby farms are not allowed. Log homes are generally ineligible, but we could consider it on a case-by-case basis if it made sense. So if you've got a log home that's not on a lot of acreage, for example, and is maybe up in North Georgia mountains, for example, or someplace that's an active rental market where it makes sense for vacation rentals, those can typically be considered as long as it meets other criteria. We cannot do manufactured, modular, or mixed-use homes, or any unique properties. Unique properties in general don't usually fit with non-QM since the qualification is already pretty expanded for these products. Good news on DSCR is that we can actually use gift funds towards the down payment. The borrower does need to make a 10% minimum contribution, and reserves do need to be verified of the borrower's own funds. But after that minimum contribution has been met, we can allow the use of gift funds, which is a vast difference than, I know, the agency world. So if you've got a borrower who's maybe going in with a family member and want to buy a property together, want to use some gift funds from them, we can consider that here. The reserve requirement is on the subject property only. Our main concern with this program is just the subject property. So any reserve requirements do only apply to the subject. You don't have to verify reserves on any other REOs. The borrower can own unlimited financed properties. So again, this is great for your seasoned landlords and investors who have a vast portfolio. We're really looking to streamline that documentation. We don't have to verify any of the PITIA payments for any of those other properties. They can finance as many as they want. Another great unique feature of this DSCR specifically is because these are business purpose loans, we can close and originate a loan where you as the LO, the originator, may not be licensed. As long as it's allowed by the state and as long as MAI is licensed in that state, we can close loans in states where you may not be licensed. So I've listed all of the states there, but this really opens up your options, especially as people look at short-term rentals and vacation rentals in an area that you may not be familiar with. Even if you are not licensed, we do have some options for us to close loans in other areas. All right, I want to go over a little bit of how we would qualify either using, we have 2 options, long-term and short-term rent. So going through the long-term rent first, for a purchase transaction, The market rent that we're going to use is going to be determined by your 1007 or your 1025 if it's a 2 to 4 unit property from the appraisal. And that's it. We allow vacant and unleased properties, obviously, with purchases. We don't require the borrower to have a lease in place before they purchase a property. It doesn't need to currently be tenant occupied by anybody. So with purchase, all we're looking at is the comp rent on your 1007. If it is by chance currently tenant occupied, that 1007 should reflect the monthly rent. But if it's owner occupied or vacant, that's not a requirement. For a refinance, we are going to use either the lower of that appraiser's opinion of market rent on the 1007 or the actual rent as indicated on a lease. They do have an option to use a higher rent amount if, say, they do have a lease and a tenant in place who's paying more than what the appraiser says market rent is. As long as that lease is still active and as long as we can get proof of the most recent 3 months of rent received, we could use the higher current lease amount to qualify. We're still going to require a 1007. We do still want to see what the appraiser's opinion of the rent is, but we do have the option to use the higher rent amount if needed. And then if the lease, the current lease has gone month to month, we are going to require 2 months of the most recent rent just to make sure that property is still being rented out by that tenant. For refinance, we do allow vacant or unleased properties, but there's an LTV reduction of 5%. So you're capped at 70% max in those cases. And then to calculate the loan, to qualify your DSCR, we're just going to take your market rent, divide it by your PITIA, and that's your DSCR. So as I said, for interest only loans, the great thing there is the market rent is divided by just the interest only payment amount, which oftentimes gives them the ability to qualify with a higher DSCR. So for example, if your rent either from the 1007 or from your lease is $5,000 a month, your PITIA or your ITIA, if it's interest only, is $4,500. 5,000 over 4,500, you got a DSCR of 1.1. Pretty simple. For short-term rent, we do have options there. It can get a little more complicated in terms of the amount that we're using to qualify. But as short-term rentals have made a bigger splash in the market in general, we have opened up the options to allow short-term rent to qualify. A lot of times these are your vacation rental areas, beach homes, lake homes, etc. They're usually listed on VRBO or Airbnb, and they generate generally higher rent amounts in these areas than a long-term lease would. So they're rented on a nightly, weekly, or monthly, or seasonal basis. We are going to base the gross rent on a 12-month average to account for that seasonality. So if you've got your beach house may not be rented as much during the winter months, we're going to average your rents over that full 12 months just to give us a better idea of what you're really bringing in. And then we are going to reduce the market rent by 20% to reflect the additional operating expenses that go up with operating a short-term rental. You've got cleaning fees, third-party management fees, et cetera, that is typically only applies to short-term rentals as opposed to long-term. So we've got a few options for determining the gross market rent for a short-term rental. You could use a 1007 if the appraiser is able and willing to complete that, reflecting a short-term market rent. That it depends greatly, I've seen, on the area where it is and how much of a short-term rental market area there is and just how much data the appraiser is able to get. But you can go to the appraiser and ask them to try to prepare it based on a short-term rental basis. We could use that. If it's already rented out, you could also use a 12-month rental history statement from your third-party management and rental service, so Airbnb and VRBO printouts. Those statements do need to be specific to the subject property. It needs to show our property address, the specific unit number, if it's a condo, the rents that were collected for the most recent 12 months, and then any vendor management fees that are charged, because we are going to exclude those vendor management fees from our rental income calculation. Again, if it's already rented and the borrower rents it out, the borrower can also provide 12 months of bank statements showing short-term rental deposits from Airbnb or VRBO, usually are the main two. And then we'll take those deposits coming in from those companies, average them over 12 months, and apply the 20% expense factor and any operating expenses. We do need proof that that property is currently listed on one of those third-party management sites. So we're going to go to Airbnb or VRBO or wherever it's listed and make sure it's currently listed for rent. And then we'll provide rental records as well from those companies. You'll see a little asterisk. We can accept a company called AirDNA offers a rentalizer and an overview report. This would be for purchase transactions only, where the borrower intends to rent it on a short-term basis. Obviously, they haven't rented it yet through one of these companies, but they intend to, and maybe the appraiser isn't able to prepare a 1007 reflecting the estimated short-term rents. They can go to AirD&D and Rentalizer, and it gives an estimate essentially of what this company believes it would rent for in that area. It's a case-by-case thing. We do have to make sure that they're paying for the right report and they're generating the right fees and everything, but we could consider that for purchase transactions only. And your DSCR calculation is going to be the same. You're just going to take the 12-month average of your gross rent divided by your PITIA, or again, we do offer interest only, so just the interest only payment. And so, for example, if you've got gross rent of $6,000, your PITIA is $4,500. We're going to apply that 20% expense factor there. So you're going to multiply it by 80, divided by 4,400, and you have your DSCR of 1.06. All right, one more key feature I wanted to go over for the DSCR loans, because entity vesting is such a big thing. A lot of people, like I said, are seasoned landlords. They own rental property companies themselves, so they want to be able to vest title in their company name. We can vest, it has to be an LLC, a partnership, or a corporation. It does need to be a US-based entity. We cannot allow foreign-based entities to vest title here. The business structure does need to be limited to a max of 4 owners. And all business owners do need to be borrowers on the loan. So that's where I said before, typically we only like to see up to 2 borrowers, but if they're vesting in an LLC and there's 4 members, we can make an exception to do up to 4 borrowers on a loan as long as the business is structured that way. We are going to review the business documents, and so we want to make sure the purpose of that business entity is limited to owning and managing real estate. We don't want a borrower who owns a pizza place, for example, vesting their rental property in the same company that owns their pizza place. It needs to either be a general purpose entity, or specifically it needs to own and manage real estate. The 1003 is still going to be in the name of the borrower or the borrowers as individuals. This is just for title vesting. This is not lending directly to the entity. The borrower is still liable for this. It's going to appear on their credit. They are still the borrower of record. And we're going to require articles of organization, the partnership, and operating agreements to review again to make sure we've got all owners on the loan and to make sure the structure is set up correctly. We are also going to require a certificate of good standing for any entities where they want to vest here. We want to make sure it's still an active corporation. All right, so that's really all I have to cover here today. I do have a list of resources here again. So our website is great. All of our non-QM products are listed there. You can go to the website and pull all of our current matrices and any forms that are needed. As well, the non-QM worksheet that's up, you can access it through any of our programs. If you or the borrowers need to complete it and submit it to our nonqm@maibroker.com email address, we can review your scenario, give you pricing details on that, make sure we've got your loan fit exactly where it should go. And then any generic scenario questions that you have can always come to nonqm@maibroker.com. We're happy to help with anything you want us to look at. If you're not sure about properties, for example, if we might be able to make an exception, go ahead, shoot us an email and we'll take a look and see if we think that property is something we could do.